This is a 2024 outlook, but I'd like to start by going back a year to this time, 2022, looking at 2023. So basically, a year ago, I think we thought that 23 would be a rebound year, and it was. So if you look at the public and private asset classes for 2022, okay, so again, almost 2 years ago, we were looking at rising interest rates impacting most asset classes. So stocks were down close to 20%. Fixed income was down roughly 15%. REITs had been hit really hard, down 24%. And on the private side, private debt held up pretty well. The CDLI was up 6.3%. The high, close to double-digit yields really provided a buffer against unrealized losses. So came in mid-single digit. Private equity was down almost 10%. Real estate was also positive. We'll talk more about that later. It was up 5.5%, actually out-earning its yield. And we thought a year ago that we might have a reversal because we thought inflation had peaked and interest rates had largely peaked, at least at the short end. The Fed had done its job. And so 2023 was a rebound year. So stocks reversed the losses of 22. International stocks still not quite reversing 22 losses. Fixed income, small positive, not reversing 22 losses entirely. Credit, publicly traded credit had a good year in 23. By the way, these are through Friday's close. REITs came back, but not nearly enough. And on the private side, private debt is measured by our Cliffwater Direct Lending Index through September. So this is only 9 months, 8.9%. We fully expect that to be closer to between 11 and 12% when the year is done. And then the fourth quarter is in. Private equity, small positive, that's through June. So again, some of these are a little bit lagged here, 3.8, but positive. And real estate is really the anomaly, being up last in 22, down in 23. Just produced a paper recently about the lag in performance on real estate. So it was a rebound year. So let me talk about, dive down into private debt, and particularly the CDLI returns. Basically updated this chart from last year. So our point a year ago was, the average return on private debt was about 9.4%. That's the horizontal line in orange, 9.4%. And there's basically this pull to yield, or that pull to that long-term return. So anytime we have a negative return on the CDLI or below average return, there's a tendency to have a quick reversal and outperform that average return. So we saw that during the financial crisis. The CDLI was down 6.5%. It took 2 years to make up for the poor performance in 2008. In 2015, this was the energy crisis, basic 5.5%, again, followed by a strong 11.2% return. And last year, we talked about the COVID 5.5%, coincidentally the same number. But we talked about that COVID number in 2020 being reversed by a good year in 21, 12.8%. And then we forecast that the poor return in 2022, 6.3%, might be offset as it had, following the pattern of the past, be offset. So what we're looking at for 2023 for the CDLI, far right-hand bar, stacked, 8.9% or 3/4, okay, through September. With our estimate for fourth quarter, basically earning the yield, right now our year-end estimate is 12%, roughly a 12% return for the CDLI. So again, two points here. Tremendous convergence to the yield, okay? The yield and the return averaging 9.4% over this almost 20-year period, where weaker years are immediately followed by good years, largely because the relatively short maturity of these middle market loans and the pull to par. So, excuse me. So let me go back here. Sorry. We'll pat ourselves on the back. Probably won't happen again for a while. But I said a year ago, we can't predict what scenario will unfold in 2023, but we have confidence private debt will protect capital within a 6 to 15% range, with 12% most likely. So who knows what's going to happen in the next 2 weeks, but feel pretty good about a prediction last year. In terms of long-term performance, so again, adding the most current year, basically steady performance for the CDLI in heavy blue, doing well with a few divots, whether it was the GFC, COVID, or rising interest rates in 2022. Again, compared to liquid credit, the high yield bond index or the leverage loan index, and then investment grade measured by the aggregate bond index. Doing well, carrying its yield in terms of long-term total return being driven by yield, but when these problems hit, being able to protect capital better than these other indices. Two major concerns that I've heard about over the last 6 months. Too much money. I'll talk primarily about that. And then a little bit later, the interest coverage ratio. Is that going to create a problem for private debt on a go forward basis? So let me talk about the too much money. I wrote a paper on that earlier this year. You might want to check that out. But this is the principal graph in that write-up. And what it tells us is, gee, if you look at aggregate supply and aggregate demand, there doesn't appear to be a problem. That is, demand has been increasing. So fundraising has been light this year. No question about that. But also, the demand for financing has grown really in proportion to the supply of financing. And this graph shows that. So the heavy line, the supply of direct U.S. private debt is a percent of demand for financing by U.S.-based buyout funds. We also showed together with that the growth in private debt financing as a percent of buyout. The percent of private debt fundraising is a percent of buyout fundraising, and dry powder on the private debt side as a percent of dry powder on the buyout side. So again, when you look at the macro factors, they seem to continue to be in relative balance. The final arbiter of supply and demand are interest rates, particularly spreads. If anything, through the year, they were mostly expanding through the year, which basically reflects more demand for financing than supply of financing. So far, we haven't been overly concerned. In terms of interest coverage ratios, there seems to be relief in sight. If you read the papers over the last few days, the media seems to be on this kick as well. But this is the forward curve. So this is the market's prediction okay, short-term rates, SOFR, okay, which is the reference rate. This is the market prediction for forward rates over the next 10 years. But most important are the next 2 years. So right now, the forward rate, which is pretty if we look at where we are today, 5.35% SOFR. But in a year, the market's expecting 4.15%. So people are expecting interest rates to come down. If you've been following inflation is running at 3+% today. So 1 year from now will be, pretty close to the where inflation is running, maybe 1% to 2% above. And then in 2 years, down to 3.51%, and that's about 0.5% above expected inflation. So the market is saying, hey, these high interest rates, particularly high real interest rates, will be coming down really over the next couple of years, and then flatten out at about between 3.5% and 4.5%. So that the market's expecting relief on the way for interest coverage ratios. But so what's our forecast for next year, 2024? So this is a bridge to a forecast of 10.5% total return for CDLI over the next year. We start with SOFR, or short-term rates, at 4.75% over the next year. Again, we're at over 5. We expect that short rates to come down by about a percent over the next year. That gives us 4.75 average SOFR rate for 2024. We expect credit spreads to stay where they are today. Don't expect any movement up or down. Again, we don't think there's too much money, so we don't expect really any compression. So that's 6.25%. We do expect realized losses, as if you've been reading our research, it's crept up last year to the long-term average of 1%. So we're predicting 1% realized losses. Unrealized gains, we're predicting 50 basis points in unrealized gains. This is a little more complicated, but part of the losses we expect next year are already captured in the CDLI in terms of unrealized losses or loan marks below par. So we expect some of those realized losses will be offset by unrealized gains next year, producing a total return of 10.50%.